Welcome to my part of the lectures. My name is Klaus Grobis. I'm an associate professor of finance here at the School of Accounting and Finance Research Group. And the part that I will teach of this RFM course is in the field of asset pricing research, and I would like to give you an overview or a brief overview of the traditional methodologies or benchmarks, let's say, used in finance research, but I also would like to give you, let's say, a new view on how the price evolutions of financial assets could be explained. And I call this the fractal view. The first lecture is entitled Fama and French, Correlation and Co. And everything that I will not cover this time, we will then continue next time. Maybe you can leave the door open in case more coming. I didn't know that it will shut down. But then we lock the door. So, in your undergraduate studies, you might have encountered Eugene Fama. And we have here obviously sort of something which you might recognize. The student above the teacher, nor the servant above the student. Now that's a very old verse. It's taken from the Bible, Matthew chapter 10, verse 27. And for those of you who do not know what that is, what is the Bible? So it's sort of a collection of narratives and stories, and it contains a lot of ancestral wisdom. It's something that the ancestors wanted us to know, and it's sort of the foundation for the culture in Western countries. So that's how I see it, and there's obviously a lot of wisdom contained in that book. And obviously, if you are not from here, those who are not from here, in other countries they have other cultures, and obviously also if they would refer to ancestral wisdom, they would obviously refer to perhaps other scriptures, if any. So, but I found this verse very suitable for this part of the lecture, and throughout this course you will understand why I chose that. Obviously, there's a certain logic here in how I set up the lectures for my part. So if you Google Eugene Fama, you will find this on Wikipedia. So Eugene Fama is an American economist, best known for his empirical work on portfolio theory, asset pricing, and efficient market hypothesis. He is currently distinguished service professor of finance at the well-known University of Chicago, Booth Business School, and in 2013 he shared the Nobel Memorial Prize in Economic Science, jointly with Robert Schiller and Lars Peter Hansen. His research papers in financial economics, they ranked him as the 9th most influential economist of all time, based on his academic studies as of April 2019. And he is regarded as the father of modern finance. And his works build the foundation of financial economics and have been cited widely. Some of the papers have been cited more than 30,000 times. That's Eugene Fama. So in your undergraduate studies, you might have encountered the capital asset pricing model, as well as the Fama and French three-factor model. In 2018, Fama and French published another study, which is called Choose Factors, and in this study they proposed the so-called six-factor model. So they simply added more and more factors to the original excess market factor. The CAPM model, how does it work? So it tells us that stocks or portfolio of stocks are fully explained by the exposure, the beta against the market factor in excess form. So if you would test the CAPM, what would you do? You would obviously, or what people in finance do, they regress the portfolio I in excess form, so they subtract the risk-free rate, right, on the constant term and the excess market factor. And then they just investigate if the t-statistic of this alpha of the intercept, if it's significant. Yeah, you might know from basic statistic classes, yeah, what people are using here, they usually use the normal distribution as a reference distribution, and you know the critical values 1.96 or minus 1.96, right? And if the t-statistic has a higher value of, let's say, 1.96, if it's, say, 2.5, then you would say, okay, the alpha is significant, and the cap M does not explain the evolution of excess returns of that portfolio I. Okay, so you would reject the cap M. So in the cap M world, all that matters is the exposure against market factor, the market beta. Then Fama and French came up with the three-factor model. They argued, or they figured out by portfolio sorts on size or the market ratio that the so-called size factor and value factor explain or describe the cross-section of expected returns much better than the cap M alone. Yeah? So they added the size factor on the value factor simply to the market factor, and that's the well-known Fama and French three-factor model. And how we test it? Same thing like with the cap M. Okay, you have some stock I or some portfolio I that you would like to price. Okay, use the three-factor model. You use these three regressors here, the market factor in its S form, size factor and the value factor, and add an intercept term in the regression equation. And then we test simply if the alpha here, if the point estimate, if the thesis indicates that this guy here is either significant or not. And the pricing model works out whether if the thesis is within this boundaries here. Yeah? And just to recall, okay, what's the size factor? Well, it's a portfolio, obviously, of small stocks and large stocks, and there are different ways how to compute the size factor or any other factor as well. So what people usually do, they use, let's say, quintile sorts, where they sort the whole stock universe into a group of 20% stocks. Okay, then they would buy those stocks that have the lowest market capitalization, the small stocks, and they would short the stocks that have the largest market cap, the big stocks. And then they keep the portfolio 1 month ahead, and then do it all over again. Yeah? And so that's the evolution of the return spread between large and big stocks is then this so-called size factor. And you can also use different sorts. Okay? You can use D-size sorts where you sort the whole universe of stocks into groups of 10%. And then you have D-size sorts. Then you can also use pair-size sorts where you have groups of 30% in the upper and 30% in the lower and 40% in between the little scale. So obviously, if you use, let's say, if you move from pair-size sorts where you have the three portfolios to D-size sorts, what you would expect is that the return spread of that zero-cost portfolio widens. Okay, but it also widens. Then we have here, in the 2015 paper, they added two more factors to the three-factor model. They added the profitability factor and the investment factor. So what's the profitability factor? I skipped the value factor because this is something that you know from undergraduate studies, right? The profitability factor, robust minus V, yeah, R and W. That's a portfolio that buys stocks that have a high profitability, robust firms, and that sells stocks that have a weak profitability. Yeah? So that is obviously one of the strongest risk factors, as we will see. So as I already said, in the 2015 paper, yeah, they proposed a 5-factor model where they added it to the 3 factors here, the RW and CMA factor. And they performed portfolio tests or empirical tests on that model. In the 2018 study, 3 years later, they proposed the 6-factor model, even though they argue in the study that the momentum factor, UMW, UMD, has no, let's say, theoretical foundation. Yeah? But people like it, and people think that this is an important anomaly, and usually all of these guys here were anomalies, okay? Value anomaly, size anomaly, and then they were promoted to be a risk factor. Yeah? So all of these risk factors are actually anomalies, or former anomalies that were promoted from certain people here at Fama and French to be a risk factor. So, and UMD here, there are different notations of the momentum factor. Most people, they like me, they are MON, right? Momentum is so easy. But here they argue it's up minus down, so up. So they buy stocks that have a cumulative upwards return, and they short sell stocks that have a cumulative downwards return over the past, let's say, 12 months. As simple as that. These are the sort of factor models, and tests are all the same. It just depends on what sort of set of regressors you use in the regressor set, or the risk factor set. Yeah. You always look on the alpha. So how are factor exposures are measured statistically? So what's the market beta? So the beta, the estimate is what? It's the covariance between the market factor in excess form and stock I in excess form. Divided by what? Divided by the variance of the market factor in excess form. We can rewrite that, yeah, because you know from statistics classes what's the correlation coefficient. It's the covariance between something divided by the square root of the variances of these two variables, right? So we can rewrite what is here to what is here on the right hand side. Yeah? So we can express the beta in terms of its correlation. Correlation coefficient, or the correlation between the market factor in excess form and the returns of the asset I in excess form times the standard deviation of the asset I divided by what? Divided by the standard deviation of the market factor. Yeah. So that's just one example, and the same is straightforward for measuring the exposure of or for coming up with the point estimate beta for all the others, for all the other factors. Here's just as an extension for the size factor. Just substitute here market factor by size factor, and then you get the corresponding formula for computing the point estimate. So you see already all of these statistics, or all of these metrics are based on the concept of correlation and covariance. So whenever I talk about covariance, I can also, it means also at the same time correlation and vice versa. Okay, so because you can express one by the other, by simple transformation here. How would we interpret this? Well, if, let's say, if the exposure, the beta 2, the exposure against the size factor, if it's larger than 0, well, one would infer that this asset co-moves with small stocks. Therefore, relative to the size factor, it is exposed to small stocks. If the asset that we investigate is a portfolio consisting of stocks like investment funds or hedge fund or whatever, we would infer that this portfolio predominantly consists or invests in small stocks. Yeah? So it co-moves with if the covariance, so if the beta is positive, because variance is always positive, right? And some deviation as well. So it's driven by the covariance. So if the beta is larger than 0, it means covariance is positive. It co-moves with what is in the long leg. If it's negative, it would mean it co-moves with what is in the short leg. So if that would be negative, then you would argue, okay, what's in the short leg? Big stocks, okay? So you would infer that your portfolio or your stock, let's say portfolio, is exposed or invests predominantly in big stocks. And the same interpretation is for all the others as well. If you want to investigate the exposure against the profitability factor, and that guy is negative, the corresponding beta is negative of your portfolio, you would obviously interpret this as evidence for that your portfolio invests mainly in stocks that have poor profitability. So this is how you would draw conclusions based upon the beta exposures of some asset. And now recall, okay, one important thing to bear in mind here is, okay, all of this is based on the concept of correlation. And another thing, obviously, the variance plays an important role here. Yeah. So, because simply, if we express the covariance in terms of its correlation, we need also the variance here. So here we have table 7 from the 2015 paper entitled The 5-Factor Asset Pricing Model, published in the Journal of Financial Economics, which many finance scholars consider as a top-notch journal. Okay, if it's really the case, who knows? But this is what many people think, at least. So what do we have here? Obviously, they use 25 test assets, yeah, sorted by what? By size and book-to-market ratio. Yeah? So we have 25 portfolios. Yeah? We move. Now, obviously, they choose quintile sorts. 5 times 5, 25. Quintiles in both directions, in the size direction and in the value direction. So we have the portfolio, for instance, this portfolio here, low in book-to-market ratio and low in size. That's obviously a portfolio that consists of the smallest stock that have the lowest book-to-market ratio, yeah? And so on and so forth. That's how you interpret these portfolios. And they argue here on page 13 in their study. The 5 factors though provide information about stocks in the troublesome micro-cap portfolio in the lowest book-to-market ratio quintile. The portfolios HMO, HMLO slope, and that means the orthogonalized value factor, that's not important for you to know, is minus 0.43 with a t-statistic of minus 10.11. So obviously they are talking about this guy here. Yeah? H is the loading in this formula against the orthogonalized value factor. Yeah, so what does it mean? So negative loading means it co-moves with the risk factor's short side. What's in the short side? Growth stocks, right? And so that's obviously, it should be not surprising. Okay? If you have portfolios that are sorted by size and book-to-market ratio, and you use a portfolio that is small and has a low book-to-market ratio, you would not expect anything else than the loading to be negative. Right? But yeah, that's just how they interpret it. So and then they argue furthermore the slope against the investment factor is also negative, minus 0.57 with a t-statistic of minus 12.27. So now they're talking about this guy here, yeah? This point estimator here. Again, we are in the small stock quintile that have the low book-to-market ratio. Yeah? So we have extreme growth stocks. So it means that the portfolio that consists of small stocks that are growth stocks behave also like stocks that have that invest aggressively. Because CMA means conservative minus aggressive stock. So in the long line of that risk factor are stocks that have a low asset growth. So they invest conservatively. Whereas in the short leg are those companies that invest aggressively. So small stocks that are growth stocks, they also invest aggressively. So this is what it means. And if we move back now, this is also obviously the troublesome portfolio. Yeah, they argue here because if you see here, what you see here in the upper panel, panel A, you see the corresponding alphas after they perform this regression here from each of these 25 portfolios sorted on size and book-to-market ratio. Yeah? And you see here that this portfolio that invests in small stocks that have a low book-to-market ratio, the growth stocks, this pricing model, their 3-factor model, generates a monthly unexplained payoff, because the alpha is the unexplained payoff, of minus 0.49% per month. But the 5-factor model reduces this pricing error, this what is unexplained, to minus 0.29. But as we see here, the t-statistic is still statistically significant with a value of minus 3.31. So it's somewhere here. So it's highly significant pricing error. So the 5-factor model. Now what you can do is actually you can count the numbers of t-statistics that are either above 196 or below 96, or below minus 196. And then you have the number of stocks that are whose return evolution remains unexplained after regressing it on the Fama and French 5-factor model. So and you see here there are quite many that have t-statistics that are significant. So we see now already on the first view that obviously the 5-factor model cannot really explain the cross-sectional evolution of these 25 test statistics, right? And in their study, this is by the way one of the key studies here for my part. They use also different test methods here. Okay, they use test methods sorted by size and profitability, or size and investment, and so on and so forth. And the results are very, very similar. So that's why I just use here one of these tables. So how to test whether the asset pricing model actually works? So Fama and French argue here, well, ALK of table 7 shows intercepts from the Fama and French 3-factor regressions for the 25 size and book map ratio portfolios. As in the earlier study, extreme growth stocks are a problem for the 3-factor model. The portfolios of small extreme growth stocks produce negative 3-factor intercepts, and the portfolio of large extreme growth stocks produce positive intercepts. Micro-cap extreme stocks or extreme growth stocks are a huge problem. By itself, the 3-factor intercept for this portfolio, as we just have seen, minus 4.49 per month, is sufficient to reject the 3-factor model as a description of expected returns on this size, on this 25 test assets or by size and book to market ratio. But this is rather a descriptive analysis. Okay, that's not sufficient to make a statistical conclusion. So to test whether or not the pricing model works, what these studies are usually doing is they employ the so-called GRS test, Gibson, Ross, and Shanker. So the problem is that if we have this kind of pricing model here, and we have test assets, what is here on the left-hand side is correlated. And we have to take this correlation into account when we want to make inference. So we have to, because these correlations have also an impact on the alphas. The alphas are also correlated. So if we use single equation models, it does not allow us to make a conclusion for the whole market. Yeah? In order to make a conclusion for the whole market, so if the model works, we need a joint test that tests all of these intercepts jointly. That means simultaneously. But not only the left-hand side variables are correlated, same as here on the right-hand side. Okay? All of these factors here are correlated. And what you will see is, or what you might have seen if you have read the paper, that the investment factor, the CMA factor, is so high correlated with the value factor that once you add the investment factor to this set of factors, the value factor becomes insignificant. Yeah. So that's something that you have to bear in mind. So that's why we have to use a joint test. So in table 5 of the same study, the 5-factor asset pricing model, here they report the results on this GRS test for different model specifications. And what you see here is, so all of these models here, they have on the right hand side the market factor, in excess form, as well as the size factor, SMP. And then just they report the remaining factors here that they use in their model setup. So, and obviously here they use different type of sorts for coming up with the risk factors, okay? But that's really not that important here. And moreover, the results are virtually the same, so it doesn't really matter. So let's focus here on the 2x3 factor sorts, okay? So what we see here is that the 3-factor model, which you see here in the first row, so 1 factor in Z form, size factor, and HML, it uses a GRS test of 3.62. Whereas the 5-factor model, it reduces this test statistic to 2.84. Yeah? The last row here, the panel A, accounts for the market factor and the test form, size factor, value factor, profitability factor, and investment factor. But what we also see is, if we neglect from the value factor, which is the previous row, the previous last row here, we have only the market factor and the test form, size factor, probability factor, and investment factor. We have the same test statistic. The GRS test is also 2.84. Yeah, so, and also we see it also here, if we now move to panel B, same thing. The GRS test doesn't change. Which means, okay, the HML factor is redundant. We actually do not need it. But how do we interpret these figures here? Yeah? So they argue here on page 10 in the paper, we're interested in the improvements in descriptions of average returns provided by adding profitability and investment factors to the Fama and French 3-factor model. For all 6 sets of left-hand side portfolios, the 5-factor model produces lower GRS test statistics than the original 3-factor model. Yeah. So, but that's actually not surprising. Because the more factors you add, purely by spurious correlation, you would see a decreased GRS test. So it actually does not mean that much. But now you have to remember, if you have read the paper, you see that they have an economic explanation. Yeah? They have this model, this discounted cash flow model, or what was it? Where how they derive for why we need, or how these factors can be derived from this valuation formula. Yeah? So they give it sort of an economic explanation. So the GRS test is nothing else than a simple F test. Yeah? And for some reason, Gibson, Ross, and Champion, these guys, I think it was in 1989, they let's say sold a simple F test as a sort of asset pricing test. They just gave it a simple F test, an economic explanation or description, and made it to the journal of finance. Yeah, it's unbelievable. So obviously, how we can think about the so-called GRS test or F test of the joint test of the intercept terms, because this is what it actually is. It gives us the sort of the average pricing error, sort of the average alpha. You can think of it as the average alpha. Yeah. But the test statistic accounts for the correlation of the alphas. And we have obviously a different test statistic. Okay? F test looks different from the normal distribution. Yeah, it looks a little bit like this, skewed, and then it has a longer tail. Depending on the degrees of freedom, of course. So how does the GRS test work? I told you already, it's just a simple F test actually. It is a joint test of the regression intercept alpha. And here in this example that we just discussed, we have 25. Yeah? So the index I is from 1 to 25. Because we have 25 tests, and we have 25 alphas in that regression model here. So we're interested in these guys here. So this is the basic, the standard econometric formula that you see here. Yeah, so if you would like to program it into, let's say, into program like MATLAB or R or so, then you would use this formula here. Okay, it looks quite complicated. But once you understood what it actually is, it is not that complicated. but I'm also not sure what you learned in econometrics here. So, but this is basically how you would set up it, and you can then basically rewrite it, because the only thing that you're interested in are all the alphas. You want to collect all the alphas here, the estimates in the vector, and it's a 25 by 1 vector here, transposed times the covariance matrix. The covariance matrix of this vector of alphas. Inverted times itself. So the first guy, so I told you that it's a 25 by 1 vector. If you invert it, what is that? It's a 1 by 25 vector. So the covariance matrix must be a 25 by 25 matrix, which has on the main diagonal the variances of each of these alphas. And above and below the main diagonal, there are the covariances between these parameters. And the matrix, if you invert it, the dimension remains the same. So it's a 25 by 25 matrix. And the last guy is again the 25 by 1 vector. And you know from matrix calculus, okay, what comes out here is it's a scalar. And it's 1 by 1 matrix. That's just a number. And that gives us the value of the corresponding test statistic that we are interested in, this lambda here. And you can also do it in Excel. Some people like to do this kind of stuff in Excel. I'm not that big fan of Excel. I'm actually using MATLAB as a program for this kind of stuff. But people can also use Excel for that kind of, and they learn. So I told you already, so the reference distribution of the GRS test, so Fama and French, they slip you around a little bit. So sometimes they use the F distribution, and at other times they use the chi-square distribution. So what you now need to know is that you can transform one in the other. So what you have to do is, so you get the corresponding value of the chi-square distribution. The only thing that you have to do is you have to take the value of the estimated GRS or F test times the number of degrees of freedom that you have. So let's say test assets. In our case, the test assets. So we have to multiply. If you want to know what is the corresponding chi-square distribution for the F tests that Fama and French report here, for instance, is 2.84. You have to multiply by 25, and then you get the corresponding value of the lambda for the chi-square test. I use usually the chi-square test, and because the F test only makes sense if you have very small number of observations. Let's say you have 30 observations. Okay, then you might use the F test because this takes into account that you have limited number of observations. But if you have 500 observations, like they have, because they have a huge data set of 50 years or so, then you don't need the F test. Okay? You can just rely on the asymptotically valid chi-square test, which is, in my opinion, much simpler. So, what's the corresponding critical value? So the chi-square test looks different from the normal distribution. If we have a lot of degrees of freedom, then it becomes more and more like a normal distribution. If we have just one degree of freedom, it is very much skewed. So, but what we want to know is, okay, where are these? We want to have 95% probability, and we want to know the critical value. So here, the space is here by 5%, and here is this 5%. So if you want to have a significance level of 5%, which is what we usually use in research and also here in ethnographic research, okay, we want to know what's the corresponding critical value here if we want to use a significance level of 5%. So when do we reject the null hypothesis, given that we have 25 degrees of freedom? So, and there's a program that's for free in the internet available, but you can also use tables, and you will see, you will find that the corresponding critical value, having a significance level of 5%, is 33.65. So whenever this lambda exceeds this value here, we know that it is outside of this 95% probability. So we would reject the null hypothesis. So, which means in turn, same logic as with the t-test, so if you reject the null hypothesis, it means that this model is not able to jointly price our 25 test assets. Yeah? And we see here, so we had this 2 point, they had reported in the paper 2.84 as the corresponding value of the GRS test or the F test, yeah. You multiply it with 25, the corresponding, if you transform this test statistic into the corresponding lambda using the chi-square test, the test statistic would be 71. 71 is much larger than the critical value. It's somewhere here. It's far outside the 95% probability. So we would reject the null hypothesis. So statistically, this joint test indicates significance. So the overall conclusion of their study is that the 5-factor model reduces the pricing errors relative to the 3-factor model. However, the 5-factor model cannot price these test methods correctly. And they have pretty much the same conclusion regardless of which test assets they use. Yeah. In their 2018 paper, which is also one of these key papers for this course, or for this lecture here especially, it's entitled Choosing Factors. Yeah? So Fama and French, they propose here a test for nested or non-nested factor models. And just to give you one example here, so here is obviously the research question is, if you have different models, which to choose? Which model should you choose? So, and one of these tests for nested models you see here. So here, what they do here is they want to test the 5-factor model against the previous model, the 3-factor model. So what do you have to do? So you have to use those additional factors that are not in the null model on the left-hand side. And then you have to test the intercepts jointly. So the two additional factors that you just add to the null model are the probability factor and the investment factor. So you put them on the left-hand side and regress those additional factors on the factor of the null model, which is Fama and French 3-factor model, and you add the intercept term. As simple as that. If you want to test the 3-factor model against the CAT-M, so obviously the model that has less factors is always the null model. Okay? It's quite logical actually. So if you want to test the 3-factor model against the CAT-M model, what you do, you regress the size factor and the value factor on the CAT-M, simply on the excess market factor, and add the intercept term. Okay, and again, we are operating with two equations, and because we have the 3-factor model has two additional regressors as opposed to the CAT-M. Here the same case. The 5-factor model has two more regressors or factors than the 3-factor model. So that's why we operate with two equations then. For a joint test, okay, now the question is, which model should we choose? The 3-factor model or the 5-factor model here? So again, we have to use a joint test. Why? Because on what's on the left-hand side is correlated with each other, highly correlated. So we have to run a joint test of the alphas, okay, and under the null hypothesis we have the 3-factor model, and obviously we have to use as a reference distribution under the null hypothesis the chi-square distribution with 2 degrees of freedom. Here, we have an excerpt from table 2 from the 2018 paper Choosing Factors, published in the Journal of Financial Economics again. Yeah. And they use here obviously 50 years of data from 63 to 2016, roughly 50 years. and they report here so-called spanning regressions. Yeah? So here in the first row, what do? They regress, they have on the left-hand side here, in the first row, they regress the size factor on the exact market factor, including the intercept term and the regression equation. In the second row, they regress the HTML factor, the value factor on the market factor and exact form, including an intercept and the equation, yeah? And so on. They do also here similar regressions for the other factors. Yeah? But again, we are interested in the joint test. So if we test here, so the first two rows here, you would use if you want to implement a joint test for testing the cap m against the three-factor model. Okay, so what you are interested in are these two guys here, these two intercepts, jointly significant. Again, we have to use a chi-square test, and if you do that, again they reported here the GRS test, but now they use the chi-square test, yeah, with 2 degrees of freedom. And it becomes, if you read the paper, you might figure that out. So again, they test the cap m under the null model against the three-factor model. And the GRS test is the test statistic is 9.20, and the p-value is 0. So what does it mean? It means we reject the cap m. We reject the null model. The cap m is not able to explain the additional factors correctly. We have significant intercept terms here. Even though, let's say, if you see the size factor, point estimate for the coefficient of the point estimate for the alpha is 0.17, and the p-statistic is 1.46. It's actually insignificant. Size factor, take it alone. But the value factor, which has an alpha of 0.43, as an intercept term, the p-statistic has a point estimate of 4.01. So jointly together, they are significant. That's why we have to use the joint test, if you want to show that. And the same thing is here. Let's just focus on operating profitability, because if you have read the paper, you might realize that obviously there are different types of profitability factors. Okay, there's the cash profitability factor and the operating profitability factor. And obviously the first study that investigated this profitability premium came up with the operating profitability factor. And I think it was Novi Marx in the 2013 paper. But then other people figured out, okay, if we construct this factor based on cash profitability, the payoff is larger and more significant and so on. But yeah, in the end it doesn't matter, because whatever three-factor model specification, whatever five-factor model specification you use, yeah, that means investment factor and any derivative of the profitability factor, okay? And as a null model, the three-factor model, in both cases, the GRS test rejects the null model, which means you would prefer you would choose the five-factor model as opposed to the three-factor model. And that's actually nothing surprising at all. But anyways, they managed to publish in that journal with this result. So here they argue, obviously here I have here some citation on page 238, spanning regressions of the probability and investment factors on market factor, size and value factor are center stage in the choice between three-factor and five-factor models. Yeah? Table 2 shows results for two sets of regressions. One pairs investment factor with the operating profitability factor version, and the other with the cash profitability version. Yeah. And the GRS test on the intercept terms from both sets reject. Now you see here, p-value is 0. So you favor the five-factor model as opposed to the three-factor model. So what's the corresponding reference distribution again? So now we are dealing with a chi-square distribution with 2 degrees of freedom. Yeah. So yeah, let's go back. We have seen the test value here for the five-factor model specification using operating probability. We have seen the corresponding test statistic and it's estimated at 17.99. And the other one is even higher. So the corresponding reference distribution is the chi-square distribution with 2 degrees of freedom. Why? Again, because we have on the left-hand side 2 different portfolios. We have profitability factor and intercept factor on the left-hand side. And the intercept terms are the guys that we want to test here. So the corresponding critical value, okay, again, we want to investigate, we want to know, okay, we have 95% probability, and we will project the null hypothesis whenever the test statistic indicates that it is outside this 95% probability. So the corresponding value giving us this rejection interval starts at 5.99. So whenever the test statistic would be larger than 5.99, we would reject the 3-factor model. And here you see, obviously, lambda is 17.99, it is larger than 5.99. So therefore, the 3-factor model is rejected in favor of the 5-factor model. And for testing the 6-factor model, which is this model that they proposed in their 2018 paper, well, this is very simple, because the only thing that you have to do is you have to, if you, let's say, you want to test the 6-factor model against the 5-factor model. So the null model is the 5-factor model, on the alternative is the 6-factor model. But there's only one more factor, and that's the momentum factor, right? So the only thing that you have to do is you have to regress the returns on the momentum factor on the Fama and French 5-factor model, and the only thing that you do then is you check the t-statistic. You don't have to, because you don't have to have a joint test, because there's only one variable on the left-hand side. And if we check here, if we go back to the to table 2 from the 2018 paper, we see, regardless of if we use the 5-factor model specification with operating profitability or the specification using cash profitability, okay? The point estimates for the alpha of the momentum factor are either 0.73% per month or 0.61% per month. Quite close to each other, and the t-statistics are 4.34 or 3.55, and both indicate significance on at least a 5% level, because they exceed the critical value of 1.96. This is how you would interpret these findings. So are there so far any questions? Better to ask now. So this is basically how you would interpret, or how you would use this kind of factor models. And now you have to remember that obviously that's the benchmark. That's the state of the art. Okay. So the capitalist pricing model, the CAPM, was proposed in the early 60s, okay, and in the mid-90s, so after 30 years roughly, Fama and French came up with the 3-factor model, okay, but still the CAPM model was used afterwards. And still it is used. The CAPM is still used, for instance, in corporate finance, capital budgeting. They use often the CAPM still. They use also the Fama and French models, by the way. But the CAPM is also still used. So this is the state of the art. This is what people are using in this type of research. And actually many people use it wrong, because the CAPM, as you might know from your undergraduate study, the CAPM is actually a two-period model. But what they do, they're treating it as a multi-period model. Because in the regression framework, okay, we have multiple time periods, capital T. You have a whole vector of returns that you regress on something. So you treat that this two-period model as a multi-period model. that's already wrong because it violates the assumption of the cap M in its original form. But people in finance do anyways. Okay. So that's something that you have to bear in mind. And then, of course, the question arises: okay, now we have so many models. Can the six-factor model price the test correctly? So obviously, in 92, 93, they argued, well, our three-factor model is much better. It's much better than the cap M because the cap M cannot explain anything. Then they figured out, okay, five-factor model in 2015. 20 years afterwards, they came up with a five-factor model, and it cannot explain either the cross-section of expected returns. And what about the six-factor model then? That's an example, let's say the 7 from the 2018 study choosing factors. Yeah. So they use now 125 left-hand side portfolios. Now they use everything, okay? They use everything. So obviously the reference distribution is here. The chi-square distribution is 125 degrees of freedom. Okay? So now they use different portfolio sorts, the size and book-to-market ratio, size and operating probability, size and investment, and so on. And they combine all of these. They put all of these portfolios on the left-hand side and run a joint test of the alphas. And they use different model specifications. So obviously, if you have read the paper, they even propose a six-factor model that consists of small stocks. Okay, they create small stock spread portfolios that explain a little bit better because obviously they have a higher variance. Okay, that's maybe not so surprising. Okay, they have a higher variance and a higher average payoff. So and you see also here, if you have this small stock factor portfolio, GRS test is the lowest in all of these tenets here. But you see, if you study this area, you see the GS and the p-value of the GS test is 0, regardless the model specification, regardless of the test assets. So even though after many years of refusing the momentum factor, they finally gave up in 2018 and added this momentum factor, which has been prior to 2018 just an anomaly, like all the others. Okay, has been promoted in 2018 after I think it was initially proposed in 1993. So after I don't know, almost 30 years, it finally got promoted from anomaly to be a factor, equity factor. But anyways, it seems that it doesn't matter how many factors you add to the three-factor model. Yeah? These kind of factor models cannot explain the evolution of returns. Yeah? In all of these tests, the underlying model is rejected. So now the question arises, what about the validity of the Fama and French factors actually? So what I have done in this paper what was published last year, I investigated international evidence using actually the data that is provided on Kenneth French's webpage. Hopefully you have seen that webpage earlier, all right? So Kenneth French, if you go over here, he has a webpage, okay? And then you find all this data that they use for their studies. That also you can use for your master's use, for instance, or for a third paper, or for fun. Okay. So I investigated the reliability of the Fama and French factor models, yeah, for different global equity markets. Yeah? We have North America, Europe, Asia, excluding Japan, and Japan. And here, what we do here is, okay, we have the null model. Okay, the first row in each of these panels, we have the cap M as the null model. And on the left-hand side, remember we have two factors. Now we have the size and the value factor. So we regress for each of these global, let's say, equity markets, local equity markets, the local factors, the local size and local value factor on the local market factor. And then we perform this joint test, this GLS test. And we report the corresponding p-value here also. And what we see is, for North America, Europe, and for Japan, the p-value is larger than 5%, which means we do not reject the CAP-M there. So in the vast majority of all other markets than the US, the Fama and French three-factor model doesn't work out. It's no better than the CAP-M. But if we test the five-factor model, which we see in the second row here, if we have on the left-hand side the local probability factor and investment factor of each of these economies, and regress it on the local three-factor model in these distinct economies, then we see that we reject the three-factor model in favor of the five-factor model. And what we show also is in the study that this result is mainly driven by the probability factor, which seems to play a role. So what we argue here is that my co-author James Colari, he is a professor of finance at the Texas University. We have written quite many studies together. So he was actually when I performed my doctoral studies, which was 10 years ago, okay, 9 years ago, I had a course at Handelsblatt School of Economics. Yeah. So I did my doctoral studies here at the University of Vaasa, but we could take also some courses at the Handelsblatt School of Economics, so that's collaboration, right? And James gave a course there in international economics. And I took that course, and then we somehow became into a passed course, obviously quite good. Otherwise, I would be standing here. And since then, our collaboration started. And we still, after 10 years, we still are in contact. He visits me, let's say, in summer, and we have a lot of fun. Okay, he's actually 70, in his mid-70s already. But in the US, you have to work obviously. Different from here. If you are, let's say, 69, then no matter what, you have to go. Okay? You cannot choose. But in the US, you have to continue work all the time. So, but what we concluded here is that a surprising finding of our study is a popular three-factor model, which has been widely used and still used as a benchmark in empirical asset pricing research over the past 3 decades. It does not outperform the CAP-M in terms of pricing equities in North America, Europe, and Japan, so in most markets. This finding is notable in that Fama and French, in their papers from the 90s, they rejected the CAP-M in the early 90s due to its inability to describe the cross-section of average US stock returns, and alternatively proposed the three-factor model. Early empirical evidence by Fama and French showed that the three-factor model outperformed the CAP-M. Our results suggest that Fama and French empirical observations could be specific to the sample market at that time. So the results of Fama and French do not replicate. Okay, there's obviously no size factor anymore, and there's no value factor anymore. So, and this is indeed somewhat ironical, I would say. Why? Because in the well-known, often cited 92 paper, this is published in the Journal of Finance, which people see as the absolute best journal ever in finance. Okay? Cited 26,851 times as of today. Okay. Fama and French on page 464 declared the death of the capital as a pricing model with the following bold statement. This was a bold statement because Sharp, Yeah, this was state of the art. The CAP-M was state of the art. Okay, everyone used the CAP-M for 30 years, and they wrote this statement here. We are forced to conclude that the sharp midnight black is the synonym for the capitalized pricing model, does not describe the last 50 years of average stock returns. So they declared the death of the CAP-M, making this bold statement in the Journal of Finance, but it turns out that their own three-vector model does not work out at all. Not if you extend the US sample either, by the way, and not in any other economy, apart from, what was it, China? Or Asia excluding China, right? They were not projected. Yeah. So the studies, there are studies from IDA or even DHF and China down, they document that the relative performance of small and large firms has been much smaller, often negative, in the early 1980s. Hirschleifer and Schwertner, so also two big names in finance, they argue that US small firm effect appears to have disappeared. And this has been confirmed in many other studies as well. Schwertner, he was actually editor of the Journal of Finance some years ago. He highlights that even the value effect seems to have disappeared after the papers that highlighted the value effect were published. And Fama and French themselves, actually, they had admitted in their 2015 paper that the value factor is actually redundant after you account for the investment factor. Why is that? So, obviously, the investment factor and the value factor, they somehow capture the similar patterns of the cross-section of expected returns, okay? But they are highly correlated. But it could be that the investment factor has a slightly higher, let's say, sample average and a little bit less variance, and therefore, if you regress the value factor, which is more noisy, let's say, it's a more noisy factor for the same type of risk problem. That's why the value factor, once you regress the value factor on the investment becomes insignificant. So you don't need it. So overall, and there are much, and I just read here some studies that I have referred to in my own study, but there are much more. If you just make your own research, and you will find many studies that actually confirm this. There is no value factor anymore, there's no size factor. There's probably never been a size factor, but that's a different story. So overall, it seems to be that we do not know much about the reliability of factor premiums. Yeah. It should be, according to Fama and French, a compensation for risk. Yeah, that's bad news, right? So, but as we already said in the beginning, Fama got the Nobel Prize in 2013. It was the same time when I did my doctoral studies. So it was for me when I started my research in all that here in this asset pricing stuff. It was very easy for me to motivate my doctoral thesis because at the same time he won the Nobel Prize for that. So I mean, of course, it's important, right? So he was not the only one who got the Nobel Prize for a contribution that does not seem to exist in real life. Not if you expand the samples, and not in other geographic markets. There's no three-vector model. Magnus Goals, Merton received Nobel Prize. Pricing of options. You know this option pricing. You might have a course here also at the university. It's not me who teaches that course, but you might have had a course on option pricing, right? They use standard deviation. It's a fundamental part of this formula. Standard deviation and normal distribution, right? That's called formula. So they received Nobel Prizes. And the key papers are here in parentheses. A journal of political economy here for Scholes, pricing of options and corporate liabilities, and then here Merton, the Journal of Economics and Management Science, for the paper entitled Theory of Rational Option Pricing. We already talked about William Sharp, but also the Nobel Prize for the capital asset pricing model, published in the Journal of Finance. Then we have Terry Markowitz, model portfolio theory, for the paper portfolio selection. It also published in the Journal of Finance in 1952. We'll come back to some of these issues later. But 1952, and this was basically the foundation for everything that followed in the stream of research. You see, because after that paper here, from 53, Sharp's paper built upon the paper of Markowitz. It was published 64. Yeah. Then, based upon that paper, Merton and Scholes. I think the studies were published in 73 and about 70, yeah, both in 73. And then the problem angle. Yeah, this is the Scarch model. Have you heard about the Scarch model? Yeah. Oh, okay. So that's a model that is also widely used as a benchmark model in empirical finance. Yeah, Scarch model. It's derived from the norm distribution. Yeah, so the innovation process of the Scarch model, the innovation process is normally distributed. So that paper here is published in Econometrica in 82. And then here the sixth in this line is Eugene Fama. Yeah, and the key paper was here published in the JFD Journal of Economics. And it's also tempted that we spoke about for risk factors in the returns on stocks and bonds. Yeah, so all of these studies here have something in common. What do you think it is? So all of these studies here, or all of these research streams, they use the variance, right? In some or another, in another type. All of this is based on the assumption that the standard deviation exists. We have a variance. We have a mean variance. We have a mean variance line. Okay? We have the risk, which is the standard deviation or the volatility, which is the square root of the variance, and we have the mean. And in this space, everything happens. Yeah, so we have the cap M, yeah, then here we have the optimal portfolio. Yeah. And if you combine it, if you now add some more factors, you can expand this frontier, okay? Yeah, then here, if you add even one more factor, here, everything happens in the mean direction. So you get for the same risk, the higher average return.
This is for risk formula.
Sorry?
This is for risk, for every risk.
The standard deviation is used as a measure of risk, yeah, in all of these research streams. Yeah. So this guy here must be defined. So if you do not have a variance or a standard deviation, there's not much you can do, right? So all these research streams, they assume that this exists. It is important to bear in mind. So, and what you might not know is that there's they share another community. So they are based upon the work from Louis Batchelor. And who's that guy? So, born in March 1870, in 1900, he wrote his PhD thesis. And it was, as far as I'm concerned, in mathematics. He wrote the thesis in mathematics, and this is in French, obviously. It was then later on translated into English, theory of speculation. So it's a French mathematician who explored French government bonds and introduced the normal distribution as the underlying distribution for financial returns. So again, all of these are based on the concept of variance, correlation, covariance, variance, correlation, all the same, or sort of, right? And the normal distribution, because the standard deviation and mean, okay, the normal distribution is fully described by what? Mean and standard deviation. So we can also say that the commonality is here is the normal distribution. And it was first introduced in 1900 in a PhD thesis in applied mathematics, okay, theory of simulation. So financial assets, according to the theory, according to the doctoral thesis, are distributed as normal with mean nu and variance sigma squared. And we can now have a small review of the distribution. So if we now, let's say we have a normal distribution and we square the normal distribution and we add another normal distribution. Again, we have a random drawing, okay, but we square it as well. And we get a number. We do this many times. And we store the numbers in the vector. These random vector, okay, these random numbers, they are distributed as chi-square distribution with 2 degrees of freedom. If we add 3 squared drawings from a normal distribution, random drawings, so uncorrelated drawings, we would have a distribution that is chi-square distribution with 3 degrees of freedom. So you can very easily derive the chi-square distribution by the sum of squared normals. It's a very important distribution for this field of research. So the normal distribution plays a major role in finance. So the methods used by Nobel laureate using Fama relies on the concept of correlation, and that's designed for normally distributed or thin-tailed distribution. So the normal distribution is a thin-tailed distribution. What does that mean? Well, so first recall that correlation-based methodologies such as OLS that you have learned hopefully in econometrics, okay, that requires that the variance or the second moment exists. Because everything that we have in finance happens in mean variance space. If the kurtosis, which is the fourth moment, does not exist, estimates derived from OLS will be sample specific. Why do you think Fama and French model doesn't work out in other markets? Or why do you think it doesn't work out if you expand the sample? Moreover, let us have a closer look at the normal distribution and what it allows for. Okay? So that's the normal distribution. I have actually copied that from some internet picture. So let us have a look at what events can we expect within one standard deviation. So if you take the integral from -1 to +1, and we have the normal distribution as the underlying distribution, how much probability would we observe for these kind of events? So if you take the integral, we will see that the probability is 68%. So 68% of all observations, given that we have a normal distribution, are between minus and +1 sigma. That's a very important number for the normal distribution. So, how many events do we have that are on the left tail and on the right tail? So, above 1 sigma and below -1 sigma. So again, if we have the normal distribution, it should be exactly 1 minus 0.68 or 33%, of course, because the whole should be 100%, right? So we also have probabilities. So if we now have a look at the Dow Jones, and I'm using here, if I remember correctly, I'm using here 150 years of data, or some daily data. So I have 37,000 observations or something like that. So I have a large number of observations, all right? that number of observations. So, and then I standardized the series. What does it mean? I subtract from each observation of the 37,500 the sample mean and divide it by the sample standard deviation. Okay. The series that I then get is the standardized return that has a zero mean and the standard deviation of 1. But then I collect all these events, all the returns that are between -1 and 1, and count them and divide them by the total of returns in the sample. And then I found that 77.5% are within -1 and 1 standard deviation. So much more than you would expect if you assume the normal distribution. However, if we go to the tails, so maybe not the right expression because the tail is much far away, but if we are below and let's say more than 1 standard deviation from the center, or less than 1 standard deviation from the center, for Dow Jones 30 returns, we have 22.5%, but it should be much more, 32%. So there are less observations here and here, but more in the middle. And if we move now, okay, let's say, how many observations are larger than 3 sigma, or less than 3 sigma? So now we are here in the tail. If we have the normal distribution, you will figure out that 2% of the sample observation should be either above 3 sigma or below 3 sigma. So not many events, not many returns should be there. But if you consider the Dow Jones 30 returns over a very long sample, it's about half of it, 1.02% only. So much less than you expect. There are less observations that are here. But interesting, it becomes interesting if you consider 6 sigma events. The probability to observe a 6 sigma event, 6 standard deviations from the mean for a normal distribution is 0 in finite samples. You have to wait many millions of years to observe this kind of event. You wouldn't observe it, not in a lifetime. But if you consider the Dow Jones 30, we have 0.13 of that sample. And you can multiply, if you multiply 0.13%, which 37,000, so you have roughly 50 of these events that exceed 6 sigma in the sample. These events should never happen. If the normal distribution would be the correct underlying distribution, you would never observe these events. Never. Not in a lifetime. Not in 2 lifetimes. So, how does real life look like? So what happened in 2021? Oh no, it was 2022. What happened in 2022? In February, Putin got crazy. What happened then? After Putin got crazy, he attacked the Ukraine. Okay. So what happened then? The NATO delivered weapons to the Ukraine in order to defend themselves, right? And what is a big player? A big company that constructs weapons for the NATO? It's Rheinmetall, it's a German company. They deliver weapons to the German military, also to the NATO. Let's say this Leopard 2, for instance, or its tanks. So whatever. So when the war broke out, so in the wake of the outbreak of this war, on one day, all of a sudden, Rheinmetall had a return of 25%. It's incredible. Okay, you can see it's a huge spike in the stock price. If you here check the February 2022 stock price quotation, because of course they got new orders, okay, new incoming order to produce more weapons. Okay, that if you compound it again as a standardized series, that's an 8 sigma event. Would never happen. If this guy would, if this distribution would be normal, this would never happen. Then another guy, I mean, you are maybe more familiar with Snap, right? Snap is, I think that's your generation. They use Snap, right? And TikTok, right? Snap is, I think, one of these companies. Yeah. So again, you had a 60% return. It was in, what was it here? The early February of 20. So this is only 1 year of data. Okay, this is only 1 year of data. Okay, and we have here already a couple of impossible events. Okay, so this 60% return is a 9 sigma event for Snap. Actually, we have here a minus 40% return. That was actually reported in the media. Yeah, so that's actually quite funny. But they didn't report that. But this data was this, I think, 5 sigma event or something. Could be also a very low probability. And the story goes on. So here, impossible events again. So of course, what happened to the Sberbank of Russia? This is one of the, I don't know, the largest banks in Russia. They have also business in Switzerland and other countries. So they had a minus 40. I think it was minus 45 also, but here it corresponds to a 10 sigma event. So they lost almost half of market capitalization in only 1 day after the war broke out. And the whole Russian stock index had a minus 30% return on that day, which also corresponds to a 10 sigma event. And this is just, I mean, these are just some examples that I thought that you might also be aware of, because it comes always in the news. It came all in the news, and obviously there are also much more events. And this is just 1 year, okay? I just have here one trading year, daily returns. So if you extend the samples, you would see these events are reoccurring, all right? And they are not only limited to certain stocks, also you will see them across in the whole cross section. You just have to choose a certain sample and you will find these kind of events. So these are reoccurring events that we consider, that we have here, that would never happen if the assumptions that people in finance have for their models, if they would actually be true in real life. Real life tells us a very different story. You can ask your parents or maybe your grandparents, because you are probably just 20 or so, but maybe you have still grandparents or so. You can ask them October 87. What happened? Okay, October 87. Stock returns down, and that was a minus 22 sigma event. 22 sigma, yeah. Never. This would never happen in 100 billions of years. Okay. This was October 1987, and it was the largest one-day drop ever happened in equity markets. Yeah. And there are a few of these very, very extreme events that it would never happen if the normal distribution would be true. So are there any questions? So next lecture, we will talk about the implications of these recurring events and how stupid some people treat them. Okay? Because we will see what we will see is, okay, some people, they use in research something that is called trimming. Okay? So what they do is they cut off 5% or so of the sample. They cut off these extreme events, okay? Upper from lower, let's say 2.5% of the upper end of the lower observations, and then they report their statistics. Which obviously makes no sense, because one of these guys and one of the outliers can wipe out everything in your portfolio on 1 day. Yeah. So what we will also see is in the next lectures, I think we will cover it here. That hedge funds, once in a while, they just blow up. Because they do not take this into account. And yeah, we will come back to some of the Nobel Prize winners, okay, who who almost took down the whole financial system in the late 90s because the models do not really work. But if you don't have any questions, hopefully you enjoyed this first lecture. Let's continue on Wednesday and see you then.